Back with us here on Halftime Report. Manish Jain, Head of Fund Management, PMS and Equity Advisory at Centrum, is now joining in to discuss the way forward for the markets. Manish, good afternoon. Thank you so much for joining in. What are you telling your clients as of now because of the volatility that you're seeing in the markets currently? Do you expect that you would wait for a further fall before you ask your clients to nibble in, or do you think that this fall has been decent enough to start nibbling in at lower levels?
Yeah, so the point is that, see, at some point of time, this was bound to happen. It's not something which is very, very surprising, given the kind of rally we've had in the last year or so. Market had already delivered somewhere close to 30% sort of a return. So 5% kind of a pullback from those levels is actually healthy. It's something that is warranted. And we do believe that in the near term, in the next 1 or 2 months or thereabouts, the markets is going to continue to remain sluggish, largely because of 2 reasons. One is the result season that is unfolding in front of us is clearly a mixed bag so far, and we are not expecting anything great. I think from an overall perspective, this result season is going to be by and large in line with what we had seen in Q1. Very low single digit sort of overall profit growth from a Nifty perspective. Now, if that is going to be the case, and plus the fact that sector rotation is now starting to get underway, where we are incrementally going to see a little bit of a movement which is going to happen away from banks and a little bit of a movement which is going to be away from autos and more towards IT, more towards FMCG, then this is a good time actually to pick it up. I don't think the market is going to correct further from here onwards in a meaningful manner. But I think from a near-term perspective, it is going to remain sluggish. It's going to be a very sideways, range-bound sort of a movement, which is going to happen in a 1,500-point zone, right? 26,000 points on the higher side and 24,500 on the lower side. So we are already kind of at the lower end of the band in our view. And from that perspective, if somebody has a 3-year horizon and want to build up a position, this is actually a good time.
Okay, all right. Well, Manish, hi, welcome to the show. What's your reading in terms of what we are seeing when it comes to the FIIs? They've been continuously selling for the entire month of October. Yes, DIIs have mitigated majority of the selling, but nonetheless, that seems to be weighing on the market. What's your reading?
So FIIs have been a little iffy, the flows, a little iffy for the last 3 years odd now, right? 2022 was as bad as it could have gotten. And I think given the liquidity that has come into the equity markets, the domestic liquidity that has come into the equity markets, I think that's actually been good enough to mitigate it. 2022 was a landmark year, right? The FII selling was at an all-time high. And yet Indian equity markets, Nifty was pretty much one of the very few global indices, frontline global indices, which actually delivered positive return that year. And this is despite the extent of selling that we saw. So I think FII flow importance in the overall context of things have been reducing, and I'm not going to read too much into it, primarily because mutual funds are still kind of sitting on a very huge cash position. So that liquidity is waiting on the sidelines to come through, and the fact that SIP flows continue to remain strong. But given that rate cut cycle has started in the US, I think global flows towards equity should pick up, specifically more from an emerging market perspective. So kind of remain a little optimistic over there.
You know, Manish, a lot of people would ask you which are the pockets that you should invest in. I'll flip the question for you. Which are the pockets do you think one should not invest in at this point of time? Because given the kind of run-up that a lot of these sectors have seen, despite having corrected 30, 40, 50% from their highs in this recent sell-off, they are still expensive in terms of trading above their 5-year average valuations as well. Is there a sector, or are there sectors that you're telling your clients to stay away from at this juncture?
See, I'm not looking at valuations at this juncture. It's more of a growth market than of a value market. 2022 valuations probably would have been more important than growth. So now from a growth perspective, I'm not really bullish on autos, and I'm not really very bullish on banks. And these are the 2 sectors where we've been continuously cutting our weight. Autos primarily because A, the valuations have run up very sharply. They are very expensive. And second is that the inventory pipeline, particularly on the 4-wheeler side, is at a very, very uncomfortable levels, right? So that's a combination over there. And banks largely because I think in a rate cutting scenario, deposit mobilization is going to be a challenge. Credit growth has been coming off, which basically means that even if you are able to maintain NIMs, then you're looking at a 10, 12, 13% sort of a PPOP growth regime as compared to 20% plus that we've seen. So particularly on the large cap bank side, I think better to stay away and move the weight more towards NBFCs at this juncture.
Okay, all right. Move towards NBFCs at this juncture. So that's the word coming in from Manish. Manish, we're going to let you go on that note. Thanks very much for joining in and providing your perspective on the markets. We need to take a short break, but as we do that, a small programming note as we slip into a break. As we prepare to ring in the festivities this Diwali, tune in to CNBC TV18's Market Movers Forum, 3 p.m. onwards on the 24th of October, featuring guests like Ramdev Agarwal, S. Naren, Nilesh Shah and others to help your portfolio prosper this Diwali.